Welcome to The Explainer. Today, we're doing a deep dive, an analyst briefing on UP Fintech's full year 2025 performance. We're going to unpack the numbers, see what's driving their growth, and really figure out what this all means from an institutional investor's point of view.
Okay, before we jump in, the usual quick disclaimer. Everything we're about to cover is for educational purposes only, so please don't take this as financial advice. All the data we're using, it's pulled straight from UP Fintech's official press release dated March 19th, 2026.
So, here's our game plan. We'll kick things off with the headline performance, then get into the nitty-gritty of their revenue and profitability. From there, we'll look at user and asset growth and wrap it all up by evaluating the long-term institutional value. Let's get to it. All right, Section 1, the headline performance. And really, to put it simply, UP Fintech had a powerful, powerful year. We're talking major growth on both the top and bottom lines. So let's start with the top line. Total revenue for the year surged by a whopping 56.3% compared to 2024. That brought them to $612.1 million. I mean, that's just incredible growth. Now, if you thought that was impressive, check this out. The profitability story is where things get really interesting. We're looking at net income skyrocketing. I mean, literally, by 181.4%, that took them to $170.9 million. That is some serious bottom line expansion. And what's fueling all this? Well, it's the sheer scale of the platform. Total client account balances hit $60.8 billion. Think about that. That's a 45.7% jump year over year. It just brilliantly illustrates the trust and capital flowing into their system. Okay, so the numbers are huge, but the crucial question for any analyst is, where is this revenue actually coming from? Let's deconstruct this record-breaking year and see what's under the hood. You know, what's interesting here is how well diversified their revenue base is. You can see it's pretty much an even split between commissions at about 44% and interest income at 42%. That's a healthy mix for sure. Okay, but here's where we have to put on our critical analyst hat. While the full year story's fantastic, the quarterly view tells a slightly different tale. Look at Q4 2025. Revenue was basically flat compared to Q3. Now it's still up a massive 41.5% year over year, but that quarter-over-quarter stall, that's definitely something to keep an eye on. So what does the CEO, Mr. Wu Tianhua, have to say about this? He points directly to their internationalization strategy and a real commitment to building a resilient business model, one with, and this is key, improved operating leverage. And that brings us to the million-dollar question for any company growing this fast, right? How sustainable is this profitability? To figure that out, we have to examine the relationship between their revenue growth and their costs. And here it is, plain and simple. This is a perfect illustration of improving operating leverage. Check it out. Revenues grew by over 56%, but their operating costs, they only grew by about 31%. That gap, that's pure profit fuel. It's exactly why we saw that massive jump on the bottom line. So let's take a closer look at those costs, because this table tells a story. Look at marketing and branding, up 73.4%. This wasn't an accident. This was a strategic choice. They heavily, and I mean heavily, invested in acquiring new customers this year. A big bet. So the question is, did that bet pay off? Let's move on and dissect the operational drivers, the user and asset growth, to see the results of that big marketing spend. And the answer is a resounding yes. They added almost 162,000 new customers with deposits in 2025. That didn't just meet their guidance of 150,000, it blew past it. The marketing engine was clearly firing on all cylinders. And these weren't just empty accounts. We're talking about more than $10 billion in net asset inflows throughout the year. That's new money on the platform, ready to generate both commission and interest income. It's the lifeblood of the business. You know, this growth wasn't just concentrated in one place. Their international expansion is clearly paying off big time. Singapore client assets were up over 50%, which is great. But look at this. Australia and New Zealand more than doubled. And Hong Kong, client assets there more than tripled. That is some serious global traction. Okay, so the numbers are strong. No one can argue with that. But from an institutional point of view, the conversation has to shift. It's no longer just about the quantity of growth. Now it's about the quality of these new customers and the long-term engagement strategy. So what is the company actually doing to build on this incredible momentum? Let's evaluate their strategy for creating sustainable, long-term institutional value. Management has laid out a clear three-pronged strategy. First, product enhancement, things like upgraded options features. Second, growing their corporate business. They underwrote 47 IPOs, which is a huge deal. And third, expanding their ESOP services, which is a really sticky business line that locks in corporate clients. And all of this ties back to that concept we talked about earlier, operating leverage. Why are these initiatives so important? Because they're designed to create higher margin, more predictable revenue streams. That's how you ensure revenue continues to grow faster than costs over the long run. And so, that really leaves us with a central question for any stakeholder, doesn't it? Can UP Fintech's strategic initiatives convert what was an absolutely impressive year of growth into truly sustainable long-term value? 2025 was phenomenal, no doubt, but now all eyes are on the future. That concludes our briefing on UP Fintech. If you enjoyed this breakdown, be sure to like and subscribe for more videos.